How does volatility affect stock options? All right, so there's a few things to note, and I think the best place to start is optionstrat.com. So this website has an implied volatility slider. So you can place whatever options you want here. You can add additional ones like a spread, and you can click the optimize tab or build, and it'll do whichever option strategy you want. So definitely start here. It really helps you visualize it. For example, if you do an out of the money call, you're going to get it really cheap, $68. Now, what happens if you buy a call for something crazy like GameStop and the volatility continues to go up? So as the volatility increases, your stock option, even if the price doesn't move, your stock option will gain tons of profit. Now, most likely the volatility increased so much because the stock did move. So the stock's going to go up maybe 15% and the volatility goes up. So naked calls can benefit tremendously from increased volatility. However, be aware that the exact same happens in the other direction. So if you buy this call for $68 and then the volatility simmers down, you've very quickly lost all of your profit. So if the price didn't move at all, you lose 100%. So if the volatility goes down a little bit, you're already lost all of it. And if the price most likely will go down, and then you're in real big trouble. And even if it goes up, it'd have to go up a lot for you to actually break even, let alone make money. So be aware that it works in both directions. Now, one way to combat volatility is to create a spread. So if you go ahead and sell a call right after it, what's going to happen is volatility doesn't matter as much as the end price will always be the same. So let's say we do something more reasonable. So if the price moves up 9%, no matter what happens to volatility, at the end of it all, once the stock expires, you will make that much money. So let's say the stock starts to go up a little bit and it stays there, you're going to increase money until it expires. So if the volatility increases by a lot, it doesn't matter to you at all because maybe you make less money immediately, but if you hold out during the close, it will always give you the same amount. If the volatility decreases, then you'll reach that much faster. So regardless, a spread is not affected by volatility. And same thing with theta, so the time decay. So as time progresses, you're not losing money. Obviously, if the stock is under, you will lose money. But again, all that matters is the end date. So another kind of strategy is an iron condor. So let me set one of those up real quick. Iron condor. So here we have an iron condor. You're going to make 100% return if the stock stays within this price at the end. So if it goes up too high, the max you can, you're gonna make 60% on your risk because you're actually putting out collateral. So as volatility increases, your chances of closing in the money might significantly change, but at the end of the day, no matter what happens on expiration, you will make as much money as you were supposed to, regardless of volatility. But the really good thing about an iron condor is if you think that the price has stopped moving, so a lot of the stocks, they shoot up and then they bounce back to the middle and they stay there. Same thing happened with GameStop, Dogecoin, everything. The price skyrockets and then once it starts coming back, it hits the middle and then stays there. So you can benefit a lot if you see that it hit the middle and it stays there. Let me actually pull up GME price so you can see what I'm talking about right here. So let's go to the 1 year chart. You can see the price skyrocketed and then it kind of just stayed here. So if you think that the price is going to stay in this range, you can open a iron condor, and as the volatility starts to decrease, because the price isn't moving anymore and people are not as excited, you're going to start seeing your returns much faster. And you can go ahead and close it out then, so you don't have to risk it going up or down. Or you can wait until expiration and it's all irrelevant. Another type is called a calendar spread or a diagonal spread. And this one's a little more interesting. Let's see if we zoom out. Okay, so you can see right here you're buying a call now and you're selling a call in the future. So that is very much affected by volatility. So if the volatility increases, you're gonna make more money from the immediate option than the one that actually is in the future, because the farther out, the less volatility has an impact on it. So let's say you have one that's very close and then you sell the one that's far away. Let me find a better deal here. Okay, so you can see 100% return or 100% loss. Now, as the volatility goes up, you can see your volatility, you benefit from it because it's almost like a naked call. And if the volatility goes down, it's going to level out just like a spread would. So it's kind of the best of both worlds. It's called a diagonal spread on option strat, but you might hear other people call it a diagonal spread. And the best thing about option strat is it actually tells you what kind of option strat it is. So you can see this one is best for high volatility, and it limits your profit and loss, which is great because that means it is good for theta. And so all of them will have just a few tags on there, and that really helps you out. But I think that covers the majority of them. Naked options, the vertical spreads, and the calendar spreads. So let me know if you have any other questions.